Is the stock market a good investment? Are bonds good investments? What about real estate in your home? How can we actually tell? Are there certain similarities that we can find between successful investments that will help us figure out if an investment is actually good for us? That's what we're going to be looking at today. Let's talk about the 4 keys of successful investments. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So the 4 major factors of a successful investment is the returns they generate, the risks they present, the costs you incur to own them, and the perks that they grant you. Obviously, the ideal investment would generate very, very high returns with minimal risks and costs, and, in addition to the returns, give you a few perks compared to its contemporaries. Unfortunately, no investment type scores absolutely perfectly in all 4 of these categories, but they usually will score well in at least 1 or 2 of them. For example, treasury bills are usually considered to be pretty darn safe as far as investments go, and therefore they would score fairly well in terms of risk. They also come with a perk that not all investments do, because the interest earned from them is often not taxed at the state or local levels, though they are still taxed at the federal level in most cases. However, the returns compared to many other investments are usually on the lower end of the spectrum, so that's the drawback. Comparatively, stocks offer, on average, higher returns, but are also more risky than treasury bills. We can drill a bit deeper into each of these major factors to get a better understanding of our investments. For example, returns can come to us in a few different ways. First, we can earn interest on the money that sits in something like a CD or savings account. Second, we may receive regular cash payments in the form of dividends on our investments or rental income. Third, our investments can appreciate in value over time, which we can later cash in on with the sale of the investment, and this is usually referred to as capital gains. And finally, through perks, we can save money that we wouldn't have been able to save otherwise through things like tax breaks. This allows us to invest more of our money and generate higher total dollar returns over time. So it's a sort of hidden form of income, but when you're comparing one investment to another, it can be just as real. Returns can also be magnified through the use of leverage, but I'll come back to that a little bit later since it also has its own risks associated with it. Which brings us to risk. Risk, as you would imagine, comes in many, many forms. So many that I'm not even going to try to give a comprehensive list here. But some of the most common ones are market risks, sometimes referred to as systematic risk, life-related risks, risks associated with the type of investment you choose, and other miscellaneous risks. Again, it's a long list. So let's start with just covering some of the most common forms of market risk. Probably the biggest example of market risks is the possibility of losing your money in the investment, such as when you invest in a company that then goes out of business. Volatility in the market value of your investment, such as the daily ups and downs of the stock market, is another example. And depending on the investment you choose, interest rate risk, which can have particularly large effects on debt-related investments like bonds, can be another example of a market-type risk. Examples of life-related risks include horizon, longevity, and satisfaction risk. Horizon risk is just the risk that you'll end up having to sell your investment earlier or later than you had originally anticipated because of some major event occurring in your life, such as a job loss, for instance. Longevity risk is the risk of outliving your savings and is particularly relevant to those who are, or will soon be, retired. Satisfaction risk is the possibility that an investment will cause you dissatisfaction in areas of your life that may or may not relate to money. For example, if you really like your privacy, you may not want to rent out rooms in your house on Airbnb, even if it would increase your monthly cash flow. So let's face it, not everything's about money. Examples of investment type risk include things like liquidity, credit, and location risk. Liquidity risk gives you an idea of how likely you are to be able to sell out of your investment and get your money back quickly. Stocks are usually fairly liquid, while homes usually aren't as liquid and therefore have more liquidity risk. Credit risk is another one of those risks that are particularly relevant to the bond market. It's basically the risk that the government entity or company that issued the bond in the first place will run into financial difficulties and won't be able to pay back the interest or repay the principal at maturity. This is what bond grades basically tell you about. A AAA bond grade is less likely to default and not be able to pay you than a bond with a C grade is. Location risk, as you'd imagine based on the name, is largely a real estate related risk. It's the risk that the location you buy your house in will go downhill, or just not uphill as fast as other areas, which can result in less appreciation than you were anticipating when you bought the home. Think about what happens to the value of the homes in your neighborhood if a street gang moves in and the crime rate starts to shoot up, or some desperate neighbor with a comparable home to yours sells their home below its appraised value. Or if you're unlucky enough to experience a natural disaster, or we hit an economic meltdown which causes the job market in the area to falter or crumble altogether. That, in particular, has obvious ramifications beyond just location risk, but you get the idea. Also, consider that since the house is usually attached to that specific location, the amount of buyers who will legitimately be interested in buying it will be limited to those who are willing to live in that location. Because let's face it, if you work in Los Angeles, you're not super likely to be looking for homes in Burlington, Vermont, unless you have job prospects there or are looking to retire in that area. But that's all part of location risk. Other risks associated with investments include, but are certainly not limited to, inflation risk, concentration risk, income uncertainty risk, financial literacy risk, and, as I mentioned before, leverage risk. Inflation risk is the risk of seeing a loss in your buying power over time because your investment's return was unable to keep up with inflation. Concentration risk is the risk that you willingly take on when you put a large portion of your money into a small number of investments, or just one or two types of investments instead of diversifying. Income uncertainty risk is the risk associated with uneven income streams. For example, if you have a rental property, you will receive rental income every single month that the home is occupied. The rent is usually fixed at a certain amount per month over the course of the rental period. But there's always a possibility that the tenant will find themselves in a situation where they can't make the rent payment. But more often than not, this rental income is fairly stable and certain. Other investments like stocks don't have that same level of relative certainty. Growth stocks could see fluctuations in their prices which alter the amount of income you receive when you sell them. Dividends could be increased, decreased, or in some cases taken away entirely. You get the idea. Financial literacy risk is the risk that you will not be knowledgeable enough about the ins and outs of an investment that you will either end up paying more than you should for an investment or losing your money altogether for things that could have otherwise been avoided. Think of things like not understanding the impact of expenses on your investment returns over time, or not fully reading and understanding the fine print of the insurance on your home, which could lead to you buying a policy that isn't right for you and then incurring costs that aren't covered down the road. And finally, as I mentioned earlier in the video, leverage risk is kind of its own thing. It can magnify returns, no doubt about that, but it can also magnify losses just as easily. Let's take a moment to examine how that works. Let's say that John has $10,000 to invest. He buys a stock with a share price of $100. Over the next year, it doubles in value to $200 a share. Fantastic. John sells and now has $20,000 in his pocket thanks to the 100% return. That's fairly straightforward, but what if John had used leverage? Say, for example, that in addition to the $10,000 he had to invest, John also borrowed $10,000 to use as leverage on that same $100 stock. Of course, it still doubles in value to $200 a share over the next year, but John now has $40,000 in his pocket. He pays the $10,000 he borrowed back to the lender, plus, say, $500 in interest for the year, and pockets the other $29,500. Thanks to leverage, John now has generated a return of 195% for the year, instead of 100%. Which sounds pretty great, right? What's the catch? Well, the catch is what your return would have been if the investment you bought went down in value instead of up. Say instead of doubling in value to $200 a share, the investment lost half of its value and fell to $50 a share over that first year. Had John not used leverage, he could cash out and have his $5,000. That's still a 50% loss, but it's far better than what would have happened had he used leverage. Because if John had used leverage, he would have sold out, had $5,000 in his pocket, all of which would have gone to the lender, and he'd still owe them another $5,500. The $5,000 that's left on his principal balance plus the $500 in interest. And that money would continue accruing interest over time as John tried to figure out a way to pay off that debt. But we also have to consider the opportunity costs that John has when he's spending more of his time and money paying off the rest of this loan instead of being able to invest. Say John had $500 a month left over after expenses to pay down that loan. It would take him roughly another full year to get that loan paid off. After his final payment, he would have about $350 left to put into an investment. So 2 years after his first $10,000 investment, John's net worth is about $350. That would basically be the same as John having an average annualized rate of return on his initial investment of about minus 94% per year. That's how much leverage hurt him. However, if he had not used leverage, he could have invested the whole $5,000 that he had left over after losing the money on his first investment. And if we're comparing apples to apples, he'd also have been able to put in $500 a month throughout that second year. And if we assume that John made about 8% on his new investments the second year, he'd end up with a net worth of about $11,660. That's like having an annualized rate of return of about minus 20% over those 2 years, which is still not good, but it's not nearly as bad as the leveraged version of this story. So you get the idea. There are lots of different kinds of risks associated with investing. Which ones you're willing to take on and which ones you're not are, of course, decisions that are entirely up to you. And some of them are only going to be relevant to specific investments. However, you should also always keep in mind that these risks can influence each other. For example, inflation risk and longevity risk can be particularly important to the early retiree. Sustained high levels of inflation have not been particularly common to this point in America's history, at least in comparison to other countries of the world. However, with more and more people retiring early every day, even brief bursts of high inflation levels could potentially be damaging to their financial futures, especially if they are also choosing to have most of their investments in things that carry high levels of inflation risk. Consider, just as a hypothetical example, someone who retired using the lean fire method of early retirement. They have $1 million saved, they spend $40,000 a year, and are 40 years old. Then inflation jumps to 15% per year for a 5-year stretch. Assuming they didn't adjust their lifestyle in retirement, and their investments didn't see significant growth during that time, they could be looking at about an $80,000 lifestyle by the end of those 5 years. That's not likely to be sustainable for the rest of their retirement, and it would therefore substantially increase their longevity risk. Thankfully, most of these risks can be managed to a certain degree, but we'll talk about that in a future video where we're actually looking at specific investments and strategies. For now, let's just move on to costs. Costs can be broken down into a few different categories. There are upfront and initial costs that you may pay right away to invest in something, such as a down payment or closing costs on a home. There are ongoing costs associated with some investments that must be paid to maintain ownership of those investments. Maintenance and repair costs on homes or the expense ratios of your mutual funds are good examples of this type of cost. And then there are hidden or opportunity costs associated with pretty much all investments and spending in general. And finally, in certain situations, there can be additional costs or penalties if the investment isn't handled properly. Think of things like withdrawing money from a 401k early and having to pay the 10% penalty in addition to income taxes on the amount you withdrew. So those are the type of costs. Now let's look at perks. Perks cover a wide variety of things, financially related and otherwise. And by their very nature, the investment's perks will be judged differently by everybody, since the perks that are most important to you will depend largely on your goals and situation at the time that you're looking to invest. But one of the best examples of investing's perks are the tax breaks that sometimes come with them. And tax breaks should be considered from a couple of different perspectives. First, consider how much of a break you're receiving from both gains and losses on investments, because not every investment allows breaks for both situations. And second, consider how often you receive those breaks. To illustrate this, think about the differences between stocks and homes when it comes to taxes. Stocks are taxed when you sell them at either your ordinary income tax rate or the capital gains rate, depending on how long you've held the investment. But you can also get tax breaks when you sell investments that lost money. This is usually referred to as tax loss harvesting. Homes, on the other hand, are taxed each and every year through property taxes, but you can receive some pretty sizable tax breaks on your profits at the time that you sell it. And depending on how you handle the rest of your tax situation, possibly get some tax breaks during the time you're living there. Other possible investing perks include the amount of time or effort, or lack thereof, that it takes to nurture and maintain the investment, and any other secondary benefits you may receive from holding the investment in the first place. Secondary benefits could include lower stress levels on a day-to-day basis when you have a decent nest egg producing income for you, an increased level of enjoyment you may get from having or doing things that your investment allowed you to have or do, or even just the satisfaction of watching that nest egg grow over time. Watching those numbers go up can be pretty fun all by itself. So those are the 4 key factors of successful investments. What do you think of them? What types of investments do you think have the best combination of returns, risks, costs, and perks? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.